a lot of traders are still struggling. The reason is simply because most people ignore the very basic of trading. Now, whenever you come over to your chart, just like you can see my chart right here, you just look at price movement and then you ignore what the information you're seeing is telling you. Price action is always the best to approach the chart. And this is exactly why I'm making this video. This is an entire course. As you can see right here, I've come up with this particular course outline and I'll be taking you through every single lesson right here. I'll hold you by your hand. So make sure you stay through because this is the first video of all the lessons I'm going to be making throughout this course. You can see almost 20 lessons. So make sure you watch every single video because guys, this is like nothing you have ever seen in the industry. I will hold you by hands and then you're going to see the predictability of what I'm going to teach you right here. You can see the first topic I'll be discussing with you is price delivery algorithm, and this is all about price action. Yes, you can choose to trade with indicators, but if you don't have a basic understanding of what price action is, you may not be able to remain sustainably profitable in the industry, regardless of what type of financial asset you're trading, whether you're trading stocks or you're trading foreign currencies or cryptocurrencies. So look at chart now. We have chart moving around and then we only know that price move from one direction to another. But why is price behaving that way? Now, whenever you come to the chart, you have to sustain a very basic understanding of why these things are happening. Right here, you can see that price is just moving. Who is moving the charts? Why is the movement happening? This is exactly what we're going to be discussing. We will start with price delivery algorithm. Right here, I have my slide. I've prepared this slide specifically for you. Now, we're going to be doing it both practical and then we're going to be doing the theory aspect of that. I will show you everything. After watching this complete course, you are going to start looking at the market differently. Unlike you used to look at it, you can use this information to trade in the spot market. You can use it to trade in the futures market. So we can see mastering price action trading. Most of the terms I'm going to be using in this particular course are industry terms, and some of them are a derivative of my personal experience over time in the market. And then the most important part of this course is the information I've learned from Michael Hodgson, the engineer behind ICT concept. And then this is basically what I'm going to be teaching you over time, and then you're going to learn everything with me over time. We will take trades together. You can join my Telegram group. The link is in the description where we're going to take trades together, but make sure you register with Bybit, which is the trading exchange I use for trading in the futures market. You can use my link in the description because that is easier for us to trade together when you are in the same platform as me. So we talk about price delivery algorithm. There are 4 components of price delivery that appear consistently across all asset classes. Now you have to understand why price moves and who is moving the market. Now I told you earlier that whenever you see your chart moving and you just saw price swing from this level to this level and then we have a retracement coming back, who is acting in this level? This is where you need to understand who are the major players of this market. They are known as the whales. You can also call them the institutions, or you can call them the big boys, the people that have the biggest money in the market. Now, as a retail trader, you can only contribute a little. And then the best way to remain profitable is to hide behind everything they are doing and then take advantage of that to make profit out of it. This is why we are doing that. Just like we said, we have 4 elements of price delivery algorithm. The first one is consolidation, also known as accumulation or a ranging market. And then the second one is expansion. The third one is retracement, and then the fourth one is reversal. There is nothing more than this in the market. Whatever chart you're looking at, whether stocks, cryptocurrencies, foreign currencies, whatever asset class you're looking at, these are the 4 components of price movement you will always have in it. If we scroll down, we're going to see them one after another, and then we will discuss what are they and how we can carefully spot them. If you don't have an understanding of this very basic thing, you will not be able to understand the advanced things we will be doing subsequently. So right here, a consolidating market or a consolidation is simply a market that does not have a defined direction. When price stays within a defined trading range and exhibit little or no willingness to go higher or lower, that is when consolidation occurs. As you can see right here, I have actually mapped out some levels where you can see consolidation, consolidation, and consolidation. So this is basically how to spot consolidation in a live market. You will always see this kind of thing repeating itself over and over. Right here, even right now, I can see right here is consolidation where market is not showing willingness to go up or down. It is just within a certain boundary, just like this one. If I just take a line like this, and then you have price moving within this range, you have a consolidated market. And why is this happening? This happens because the market makers, or who we call the whales or the big boys, are accumulating order. Why is it happening? If we are to check this carefully, we will know that this level is a level where these guys take order from buyers or sellers to deliver it to another direction. For instance, these guys come into the market with very huge amount of money. Let's take $1 billion, for example. If I'm going into trade like an institution and then I have $1 billion with me, okay, if I have $1 billion with me, this is just an example, okay. At this level, if I want to execute my trade and I have sellers that are willing to sell for me, less as the market is coming down around this level, I will have to accumulate order. People are selling it for me from this level to this level, and then I have $1 billion. If I have people selling just 300 million worth of the asset I want to buy, okay, let's say 300 million right here, which is MN, okay, and I have an order of up to $1 billion. You can see at this point I will have to wait for my order to completely fill. I have $1 billion, and then the only thing I could have to buy is $300 million worth of the asset I'm willing to buy. So the reason why this thing stays around this level is to ensure that all my orders are completely filled. The $700 million that will now remain will have to be filled over time before price will be delivered to the other side of the price movement, which you can always see right here. After consolidation, we can see price delivering down to this level, and then we have consolidation again. Market has been in this level over time. We can see it clearly from this range. Market has just been within this range for a while, accumulating, and then subsequently it delivers down. So this is basically why we have accumulation, where the big boys or the whales are gathering orders because they have very huge order to execute, and then they will have to wait patiently to accumulate order, whether they are buying or they are selling, before price will move. So this is why we have a consolidation in a market. And when price are in a state of consolidation, it means that market makers are allowing orders to build up or collect on both sides of the market and are anticipating new expansion in the near future. So this is basically what I just explained to you. So the next one is expansion. Expansion, also known as the breakout, where you see people tell you breakout trading. It breaks out from that ranging market after they have gotten enough order, and then they are willing to deliver it to the next side of the price. So we can see when price suddenly moves away from a consolidation or accumulation level, this is known as expansion. Right here, we can see from this particular picture I put right here, after it has accumulated or consolidated for a while, it broke above this level, violated this resistance level, and then that is when we saw price delivering to the other side, just like we've seen in the past chart we have right here. After it has accumulated for a while in this level, and then it broke below this level to deliver to this end again. So this is where we have expansion. Is just expanding from that level. So retracement occurs when price returns to the most recent price range. Simply put, it is the movement that occurs following an impulse move or expansion move. So whenever you see price delivered from this level to this level, we expect to see price coming back to retrace or filling up the gap that is left here. Now I will show you this when we go to the chart. I will show you why this is happening, because Imagine you are selling something from this highest price and then it comes to this lowest price. You definitely will be selling it very cheap. So you allowing it to come back to a half the price or maybe to go back to the initial price will give you more profit, or it will give you more benefit. That is why retracements comes into the game whenever we are dealing with price movement. So if we go to our chart right here, we can see retracement in almost every movement of the market. Let me delete this so that you're going to see it. If I delete this guy, now look at what happened from this place to this place. Price delivered from this level, okay, from this level to this level, price delivered. Let's assume at this point price is even here, price is around $32,000, okay, at this level, and then it came down to this level where it is $17,000, okay. This is very cheap. Imagine you are selling a product from this level, it then came down to this level, $17,000. You definitely will not be happy to keep selling it here. You will want to allow the price of that asset to move up again, maybe to half the price, which is around $26,000, okay, before you can keep selling it again. So this is why these guys allow price to take it up again and then keep selling. As you can see, once it reaches this level, they sold it again because they felt, okay, this is a level we want to keep selling again. We can see that price has given us a lot of chance to sell at a higher price again. So whenever these institutions are selling at this level, they are actually bleeding because they are not making money from it. The only way they can make money is when they allow price to push up again, okay, to the initial level, which is this level, or to come half the level and then sell it again, and then they can make more profit from that. And that is why retracement comes into the market. So when you understand who is playing out in this market, you would be able to know why certain things happen in the market, and then you will be able to know exactly when to expect this particular movement. So all I will request from you is to go ahead and check around and see where you can see price retracement. You can see from this level to this level, all this movement from this level is a retracement. This is also a retracement. Imagine somebody selling at this level to this level, and then it came back to almost $48,000 from 52. You will want to sell it again. So these guys kept selling it from this level again to push it down. You can see this repeating itself both on the sell side and then on the buy side. Imagine this one from this level, somebody buying to this level, and then it is at this level very expensive. They want to see price coming down to maybe a cheaper price before they take it up again. So this is how this price delivery algorithm works. This is basically how you can spot out retracement in a live trade. So we can go to the last one, which is reversal. So reversal is when price reverses its current direction. It is said to be in reversal. So what happens is that if these guys buy from this level, they want to take it up to where they can sell it to somebody. Now, the only way you can make profit from something you buy is when you sell it at a higher price. So this is why if they buy it at this lower price, they will sell it at this higher price. And then they allow it to come down again and take it up to sell it around this level. The reason why they are taking it above this last level is because everybody that is selling will have put his stop loss around this level. And then when you put stop loss for a sell order, you are actually saying I want to buy at that price. So a stop loss for a sell order is actually a buy. I will take time to carefully explain how these things happen for you subsequently during the course of this particular course. So you can see that these guys will accumulate order from here and deliver it to the next side of this particular price, allow it to come down, deliver it. So you can spot this in every kind of asset class. You can see them over and over repeating themselves. If you reduce this, let me expand this, you can see price have delivered from this level and then delivered above this level where people's stop losses are, and then reverses to this level, delivered below this level, and then reverses again to another level. We can see taking up and then push it down. So you can see reversal in every movement of the market happening over and over and over again. So once we finish delivering to the next side, we take it down again, price changes direction, deliver to the upside, take down again. This is how we are going to see it. I'm going to explain about market structure for you subsequently. so that you will get a very deep understanding of what these things are and how these things form. So you can see them. You can go to your chart and spot all these things I've taught you right here, and then we will continue with the next topic that you will need to learn, which is understanding market structure. I will take time to explain to you. These are very basic, but if you don't know how these things operate, you will not be able to understand the advanced things we'll be discussing in this course. At the end of this course, you will be able to look at chart and say, this is where price will be reversing. This is why this is happening. And then you are going to be profitable from those information. You will filter out the trades you're supposed to take and then the trades you're not supposed to take. So guys, make sure you register with Bybit with my link in the description and join the Telegram group. This is the first video. I will be dropping the rest of the videos and then you will see it. You can also click on the next video right above my head from this suggestion link. Make sure you follow everything I'm teaching you right here. Thank you guys for watching. See you in another video.